Hello, this is Simon Thompson, Vice President and Wealth Advisor at Texas Legacy Wealth Management. Welcome to our monthly market update for April 2016. We're going to walk through the major market events of the month. After a historic first quarter in which we saw the S&P 500 rally from down over 10%, only to finish in positive territory, April left that volatility in the rearview mirror as we closed the month less than 6 points or 0.3% higher than where we started. This lack of volatility was in direct contrast to what we saw to start the year. In fact, the month ended by going 12 straight days without a 1% move up or down and finished with only 4 1% moves for the entire month. This came on the heels of just 3 1% moves in March. Compare that with the 23 combined that took place during the first 2 months of 2016. Volatility has calmed down considerably. Through the end of April, we've had almost 2/3 of the S&P 500 report first quarter earnings. As expected, year-over-year earnings growth has been ugly, with earnings per share down about 5.7%. Expectations going into this earnings season were bleak, and despite the rough year-over-year numbers, we've seen about 75% of companies beating the pessimistic expectations, which is slightly above average. Consensus expectations for the path of earnings this year is for a tough first quarter, followed by steadily improving earnings throughout the year, culminating in projected fourth quarter 2016 earnings estimates of about 7.5%. For all of 2016, analysts are projecting earnings growth of roughly 1%. We continue to see companies cite the strength of the dollar and lower oil prices as headwinds for earnings. These factors impact different sectors and companies in different ways, but as a whole, we anticipate that these headwinds could turn to tailwinds and serve as catalysts as we move toward the back half of this year. April was relatively quiet on the central bank front. We saw little surprise in the U.S. as the Fed kept rates unchanged while keeping options open for a potential rate hike in June as they acknowledged some improvement in economic conditions, although a weak first quarter GDP number of 0.5% growth shows there's work to be done. Meanwhile, the ECB continues to strike a dovish tone, and the accommodative policy we've seen in Europe is likely to continue. The biggest surprise in April was the Bank of Japan's inaction. The market was expecting some sort of accommodation, but the BOJ disappointed by failing to deliver a cut in rates or an increase in asset purchases. The yen has rallied to an 18-month high versus the dollar on this surprise. As we look toward the remainder of 2016, we're cautiously optimistic on both the stock market and U.S. economy. We feel that the fundamental economic data in the U.S. has stabilized and is showing signs of improvement. We don't see signs of a recession on the horizon. Many of the market worries from last year continue to plague the U.S. economy and corporate earnings. Specifically, we continue to watch closely oil prices, central bank policies, and currency fluctuations. One potential market-moving event unique to 2016 is the Brexit. This is the possibility of Britain departing the European Union. The UK referendum is scheduled to happen on June 23rd, and you can expect to see the market focus on the many potential consequences if there's a leave vote. Current polls show a narrow edge for the UK to remain a part of the EU. While we continue to feel that positive returns for stocks by the end of the year are possible, we do expect to see further volatility. We believe now is a great time to review overall asset allocation, particularly if the volatility we experienced during January and February was uncomfortable. The recent rally has presented a great opportunity to address asset allocation and ensure it's in line with long-term goals and objectives. For more information, you can contact us via phone, email, or visit our website. Remember to follow us on Twitter and like us on Facebook. Thank you.